Has this ever happened with you? One fine morning, you check that red stock on your portfolio and you go like,
Oh god, the stock is down almost 50% from its peak. That's it. That's it. I'm selling.
no. This is usually the exact moment you shouldn't be selling.
Wait, what?
Yes, hear me out. Over the last 15 years, every time the Nifty 50 has stayed almost flat for nearly 2 years, the next 2 years have delivered returns of up to 44%. And right now, the market is moving in a similar phase. So in this video, I'm not going to talk about the index. I'm going to show you 5 real companies where this exact same story is playing out. The stock has crashed, the headlines are scary, but if you actually open the results and look closely at the business, it's quietly getting stronger, not weaker. Now, this doesn't mean every beaten down stock is a good investment. Some stocks fall because the business is genuinely broken. But others fall even when the business continues to grow. And those are the companies we are looking for today. For every company, we'll answer 5 simple questions. Why did the stock fall? What does the business actually do? What's going right? What's the biggest risk? And finally, is the stock actually cheap or does it just look cheap? So let's get right into it. Think about it like this. A stock price and a business are like two people walking together. And this is the start line. Most days they end up walking together side by side. But every now and then fear takes over and the price runs way ahead of the business. Or in our case today, it falls way behind it. This is price, by the way. Now, this gap between what a business is actually doing and what the stock price is telling you is where the real opportunity lies. Because sooner or later, the price comes back to walk next to the business again. And this is called mean reversion. And smart investors spend a lot of time looking for exactly this kind of gap. Let's start with a company that for years had almost no competition. Stock number 1 is Indian Energy Exchange or IEX. This is a company that had no competition for a long time. Today, its stock is nearly 60% down from its all-time high of 319 rupees, currently trading at 129 rupees. Now let's understand the business. For years, IEX was the place where buyers and sellers came to trade electricity. Think of it like the stock market, but for power. Power producers come here to sell electricity and power buyers come here to buy it. And because almost everyone used IEX, it became even stronger. More buyers attracted more sellers and more sellers attracted more buyers. And that's a very powerful advantage that most businesses never get. But then what changed? Why did the stock fall almost 60%? The answer is market coupling. The government wants electricity prices across all exchanges to be discovered through one common system instead of each exchange setting its own price. And investors fear this could reduce IEX's biggest advantage by making it easier for the competitors to catch up. That's actually a real risk. But here's what the stock price isn't telling you. In FY26, IEX traded a record 14.1 thousand crore units of electricity, which is up 17% from last year. Revenue grew to 747 crore. Profit grew 15% to 493 crore. So while the stock has been falling, the business has continued to grow. And the company isn't stopping with electricity. It's also building businesses in gas trading and carbon trading. Its gas exchange grew volumes by 28%, while its carbon exchange saw renewable energy certificate volumes jump by more than 200%. IEX has also received in-principle board approval to explore setting up a coal exchange, which creates another long-term growth opportunity. Now, there's another trigger worth watching. Its gas exchange, which is IGX, has already filed its DRHP for an IPO. If approved, it could become India's first listed gas exchange while also helping IEX meet regulatory shareholding requirements. Now, here's what investors need to watch. If market coupling changes the industry's economics, IEX's competitive advantage could weaken, but over time. That's the biggest risk here. But here's what's interesting. Today, IEX has a market cap of around 11,800 crore and it trades at around 24 times earnings. Its own 10-year average is 39 times. So the market is valuing this business much lower than it has in the past, even though the business itself is growing. Now let's move on to the second company, Persistent Systems. The stock corrected nearly 20%, falling from around 6,789 to 5,500 rupees. But interestingly, the reason had very little to do with the company itself. When China's DeepSeek AI model grabbed headlines, investors started worrying that AI would reduce the need for traditional IT service companies. At the same time, there were concerns about the slower global technology spending, and Persistent got caught in that fear. But here's what makes this company different. It's no longer just an IT services company. Today, it's helping global businesses adopt AI, modernize their applications, move to the cloud, and build better data platforms. Now, let's look at the numbers. Persistent has now delivered 24 consecutive quarters of revenue growth, not a single quarter of revenue decline in the last 6 years. In FY26, revenue grew 23.5%, while profit grew an even faster 33%. The business is also well diversified. Around 40% of its revenue comes from software and emerging technologies, 35% from banking and financial services, and 26% from healthcare. It also works with 20 Fortune 50 companies, which gives it access to some of the world's largest technology budgets. It also works with 20 of the Fortune 50 companies, which gives it access to some of the world's largest technology budgets. And the company isn't just talking about AI, it's investing in it. It is strengthening its partnerships with NVIDIA and Databricks while building its own AI platforms to benefit from the next wave of enterprise AI adoption. At the same time, it's also expanding its global presence. Nearly 80% of Persistent's revenue comes from North America today. That's a huge opportunity, but it also creates concentration risk. So, to reduce this dependence, the company is partnering with Nagarro to build a combined AI-led digital engineering platform with a much stronger presence in Europe. This platform is expected to have annual revenue of nearly 25,000 crore. But this is also the biggest thing investors should watch. The acquisition is debt funded. So how smoothly the integration happens over the next few years will play a big role in determining future growth. Now let's talk about valuation. Today, Persistent has a market cap of around 85,500 crore. It trades at around 44.3 times earnings compared to its own 5-year median of 55 times. So despite continuing to deliver strong growth, the stock is trading below its own historical valuation. Now let's move to a company that many investors believe has no future. Stock number 3, CMS Info Systems. The stock is down almost 60% from its highs, and honestly, it's easy to see why people think the story is over. After all, India is rapidly moving towards digital payments. In June 2026 alone, UPI processed 2,270 crore transactions worth nearly 29 lakh crore. So naturally, many investors assume cash is disappearing. But here's what's interesting. Cash usage in India is still growing. Every single day, CMS replenishes more than 70,000 ATMs, services 20,000 bank branches, and manages cash across over 65,000 retail touchpoints across the country. But the company knows it can't depend only on cash forever, so it's quietly changing its business. Today, CMS also offers banking automation, managed ATM services, software solutions, and remote monitoring for banks. In simple words, it's slowly becoming a technology and services company built on top of its cash logistics business. And that's starting to reflect in its order book. The company enters FY27 with more than 2,000 crore worth of confirmed order wins. Even more importantly, around 85% of its FY27 services revenue is already logged in through long-term contracts, giving it strong revenue visibility. Management also announced a 168 crore share buyback at 340 rupees per share, which usually signals confidence in the business and its valuation. But it's important to look at the other side as well. FY26 wasn't a great year. Revenue grew only 3% to 2,500 crore, while profit actually fell 18% to 300 crore. Management says this happened because of 4 temporary issues. One, consumer cash usage was soft. An SBI contract got delayed, the exit of a large competitor disrupted the business, and banks continued shutting down low-yield ATMs. Now, the key question is simple. Are these one-time issues, or is this the beginning of a long-term decline? That's what investors need to watch. Because if cash usage starts falling meaningfully over time, the company's core business could come under pressure. Now let's look at the valuation. Today, CMS has a market cap of roughly 4,351 crore and it trades at around 14 times earnings compared to its own 10-year average of 18.6 times. So once again, the market is assigning a much lower valuation to a business that is still finding new ways to grow. Now let's move on to probably the most well-known company on this list. Stock number 4, HDFC Bank. It is India's largest private sector bank. In fact, it makes up almost 1/4 of the Nifty Bank Index and nearly 10% of the Nifty 50. Yet this stock is still trading almost 30% below its peak. So why hasn't it recovered? Now on the surface, the market's reaction seemed reasonable given the controversies, but the biggest reason is pressure on its net interest margin or NIM. In simple words, that's the difference between what the bank earns on loans and what it pays on deposits. Over the last few quarters, that gap has narrowed. Lending rates came down faster than deposit costs, while competition for deposit remained intense. That's why investors have stayed cautious. But if you look at the business, the picture looks very different. In Q1 FY27, HDFC Bank's loan book grew 13.4%, crossing 30.5 lakh crore. Profit also grew 18%, while asset quality remained strong with gross NPAs at just 1.17%. The bank is also making an important strategic shift. Today, it's increasing the share of retail loans in its overall loan book from around 52 to nearly 60%. Because retail loans usually generate better margins over the long term. And then there's another trigger that many investors may be overlooking. The RBI has reopened the foreign currency non-resident bank deposit window for NRIs. Management has specifically highlighted July, August, and September as important months to mobilize these deposits. The last time this happened back in 2013, HDFC Bank used this window successfully during a liquidity crunch. If history repeats itself, it could support the bank's margin sooner than many expect. But there are still things to watch. The CASA ratio, this is simply the share of deposits that come from current and savings account, which are the bank's cheapest source of funding. After the HDFC Limited merger, this ratio fell from 38% to 32%. Improving this is important because lower funding costs usually help improve margins. And because the bank is expanding its retail loan book, any slowdown in consumer credit could delay the benefits of this strategy. Now let's look at the valuation. Today, HDFC Bank has a market cap of around 11 lakh crore. It trades at around 1.9 times price to book compared to its own 10-year average of 3.48 times. For India's largest private bank, that's a meaningful discount to its own history. Now let's move to our final company. It's a business that almost all of us have used without even knowing it. Stock number 5, Pine Labs. The stock is down nearly 47% from its post-listing high. But before we understand why, let's first see what the company actually does. Pine Labs operates one of India's largest point-of-sale or POS terminal networks. These are the payment machines you see at checkout counters in shops and restaurants where you simply tap, swipe or scan to make a payment. Imagine you're buying a 70,000 phone using your credit card. Within a few seconds, your payment goes through, your no-cost EMI gets activated, any cashback offer gets applied, and the store gets confirmation that the payment is successful. Behind all of this is Pine Labs. It connects banks, card networks, merchants, and brands, making the entire payment process work seamlessly. And that's how the company earns money. Most people think UPI is replacing card machines, but that's not really what's happening. Nearly 70% of the transactions on Pine Labs' offline payment network now happen through UPI, with an average transaction size of over 1400 rupees. So instead of hurting the business, UPI is actually running through Pine Labs' payment network. And the company isn't stopping at payments, it's building software on top of its payments network. For example, Signal IQ helps banks assess loan risk using real transaction data. Credit Line on UPI enables lending directly through UPI, and Growth Hub helps merchants better understand their customers. Management says all these software businesses are steadily gaining traction. But there's a challenge. This is one of the most competitive industries in the country. Banks, fintechs, and global payment companies are all competing for the same merchants. So Pine Labs now needs to prove that it can become a software-led platform and not just a payments company. That's the biggest thing investors should watch. If we talk about valuation, today Pine Labs has a market cap of around 17,400 crore and it trades at around 135 times earnings compared to its own 10-year average of 149 times. It's definitely not a cheap stock, but it is trading below its own historical valuation. Now let's come back to where we started. Remember the investor who was about to sell because the stock was down 50%? Here's what I'd tell him. A falling stock price tells you how the market is feeling. It doesn't tell you how the business is doing. And that's why before you sell any stock, ask yourself one simple question. Has the business actually become weaker or has only the stock price fallen? Because not every falling stock is a good investment and not every falling stock is a bad business either. That's exactly what we saw today. 5 companies, every one of these companies has their real risks, and that's exactly why they are available at lower valuations today. The opportunity isn't in buying every stock that's fallen, it's in finding the businesses that continue to improve while the market is focused somewhere else. So here's my question to you. Out of these 5 companies, which one do you think has the strongest comeback potential? Let us know in the comments. And if you enjoy this kind of research-backed content, don't forget to subscribe. I'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.